We're going to follow on with our next panel. This next panel is Venture Capital and Private Equity in the Luxury Market. We're going to be talking about investment, and of course all these people are very interested to know about that as well. So I'd like to ask two people to come and join me here on the stage. Hopefully they're in the room. Caroline Reyl from Pictet Asset Management. Yes, you're here, of course, we saw you earlier on. And Quentin Reyes, I'm hoping I'm pronouncing your last name properly, or Reyes, from Alpha Praetorian Capital. Thank you for joining me. Okay. So again, we're talking about investing in the future of luxury brands. Caroline, we had a pre-talk before this, so we had a bit of a chance to chat. Quentin, is it Quentin or Quentin?
Both, I guess. Like you can use Quentin in French or like Quentin in English.
Okay, so it's Quentin. All right. So with the English accent, we'll call it Quentin. Quentin, you're head of Alpha Praetorian Capital. Tell me first about APC and what your role is and how long you've been there, and a bit about your background as well.
Sure. So, I mean, initially I was a tech entrepreneur, so based out of Shanghai and then Hong Kong. And then when we exited, we decided like VCs were not appropriate. The model was a bit broken. So with my partners, we decided to build what we call next generation VC, which is where we are all capital partners. So we don't have a GPLP model. We manage proprietary capital. So this led us in October 2021 to launch this structure, APC, which was we wanted to have a more activist role in terms of like beyond investing. Investing was just 20 to 30% of what we actually do. Most of our activities are post-investment, helping our portfolios. So that's pretty much where we act right now. So I think the beauty of being a proprietary capital is that we spend less time in marketing as a fund. So we don't go on Twitter about how great our portfolios are doing, but we're actually on the boards and helping them really go to the next level.
Okay. Caroline, you're head of premium brands for Pictet Asset Management. A little bit different because you're not necessarily into venture capital per se or private equity, but very much into investment, big scale in this industry. Tell me a bit about your company and how it works.
Yeah, thank you. So I have been working at Pictet Asset Management for the past 20 years. So it's been a while, and as a financial investor in the luxury industry. But as mentioned, it's pretty much listed companies. So I typically invest in large groups, the LVMH, Richemont, Hermès of this world. But not only in the traditional sense of luxury, I also invest in premium brands across consumer segments. So we also look at the hotel industry, cosmetics, even sporting goods, anything basically which is branded and high-end. And the advantage of having been there for more than 20 years is that I have been through cycles. And what I can share with you is that as an investment, luxury is also very interesting. And share prices are able to go through consumer cycles. And what we have seen after the financial crisis of 2008 and 2009, as well as the COVID years, which were horrible for any industry, I would say, the rebound in luxury spending is always there. And it's been something recurring, and as a shareholder, a long-term shareholder, it's something actually very good also for returns.
Are you also investing in luxury hotel brands? Is that part of the portfolio?
Yes, as long as they are listed, definitely hotels are being considered. It's probably 20% of the portfolio today. And as was mentioned in previous sessions, even the large traditional luxury groups go into hotels, yes. And it is part of the luxury experience, and you find synergies for large groups also being present in hotel, restaurants, and others. The logic of being invested in the high-end segments is that you have pricing power, because you invest in desirability. As was said before, this is key, I guess a key concept across segments, and that allows loyalty, high barriers to entry, and pricing power. And frankly, after the crisis we have seen after all these years, the high inflation environment we live in, having this ability to continue and have your clients despite higher prices is also something very appreciable for shareholders.
Now you're sitting on top of 4 billion euros, is that correct? So it's
yes, so the strategy was started in 2005 exactly, and we started with 0, and it has been quite successful in terms of asset management, because today I think we are among the largest probably in Europe with close to 4 billion euros. Now we are big, but we are extremely selective in the investments we make. Not every company is good on a return perspective. So we invest only between 30 and 50 companies, despite the large assets. And we are very rigorous in the investment process we have to select the most aspirational brands where we see growth, not only growth on the top line, but also productivity, so operating margins that are able to continue and grow over time. So we need to have confidence in the business models of our companies. And the third thing we look at, to be very precise in our investments, is the cash flow generation. So I guess that's a bit of a difference between ourselves and the private equity or venture capitalist world, is that we like to see the cash flow machine being started, as it often is the start of value creation for shareholders, at least at this stage of investments, so when we look at large companies.
Okay. Quentin, I believe you're working a great deal in helping creators build Web 3.0, is that correct?
So, yeah, I mean, it's funny because this is what led us to luxury. So we're not only into Web 3, but given that this is some of our successful portfolios we have is what we call Web 2.5. And how we got into actually investing into more of these tech related to luxury, which is that they were solving some of the major industry pains, which is CRM and consumer data and consumer journey. And so that's where Web3 was interesting, because in the age of like GDPR and like all these regulations for data privacy, they would see the wallet as an alternative to be able to have a better understanding of their user journey. And that's how we decided to deploy more capital in these segments of what we call Web 2.5, which is in between. Very kind of like the experience we have on internet every day, but on the data management behind, this is a fully decentralized technology.
That's interesting. We've been talking a lot over the past couple of days about technology in this industry. What are the stakes then in technology in the luxury industry, and how big is it going to get as part of the overall recipe?
So it's very fascinating, because I think 3 years ago, I would have no opinion on this, because I think luxury has been very famous for not innovating in the sense of technology. When you compare to really every single industry, from supply chain, industrial, like they are years ahead. And they had to wake up, I think, with COVID. With COVID, it was really like the slap in the face for a lot of people, being like, okay, we need to change because consumers are getting younger, interactions with IPs getting more and more digital. So we need to understand how these behaviors are changing. And so how tech in the luxury industry is going to happen, I think we're just at the beginning now. Now it starts to be interesting. When you see like these massive conglomerates who are starting to build their own VCs in-house, their own research departments, their own developers, that's incredible, to be honest, to see what's happening. I mean, we're interacting with these massive luxury groups, and the fact that they have actual teams of developers to be able to do right assessment of their own products is incredible when you think about this. So we think right now we're really like stage 1 of the rocket. That's why as a VC we're interested, as opposed to if there was too cash flow, we think the opportunity is gone. And that's, I think I see more and more of my peers actually deploying more capital in that space. Yeah.
So you're working with a lot of startups. How do you work with startups? What are the nuts and bolts of the story?
So obviously we're not angel in the sense of like when we come in, it's usually at seed A, B. So it is already like a proven business model. So they make money in the sense. Obviously, very few of them are cash flow positive, but the traceability of scalability, what matters for us is growth. It means we're doing analysis on quarters. But a lot of startups, the problem they have is what we call a clusterization problem, which means they work on their tiny solution every day that they think the world needs what they're building. And that's a really, really common problem we have in entrepreneurs, is that they're convinced that people need them. And we had to tell them that nobody needs their solution. They need to make the life of the end user so 10x better, then we'll go the leap of faith for trying something new. And that's always complicated conversations with entrepreneurs, and that's why we tend to invest into second-generation entrepreneurs or people who have been, experts in the industry. That's why luxury is great, because usually you have, people who have worked in the space for 30 years, they know exactly industry pains, so it's easier to take a leap of faith with these people.
But it is a leap of faith, isn't it? Because, I mean, even at that stage, when we were talking with someone yesterday who was saying, people ask us for projections 2 or 3 years out for something that we have no idea how to make the projections. I mean, if you've got nothing else to base your projections on, it's a leap of faith.
100%. So at the end of the day, it's an investment into the people. A company startup will have to do at least 1 pivot, if not 2. Any successful stories you have in mind here had to do at least 2 or 3 pivots to be where they are right now. So at the end of the day, it's really an investment to the team, the core team, and who is their ecosystem network, and how fast can they develop a new product if they have to.
Okay. Getting back to Caroline, talking about the market evolution, and you've been following, now this is the overall market now we're looking at. What are you seeing as being the sweet spots in the luxury market today in terms of investment?
Okay, maybe I'd like to rebound a little bit on what Quentin was saying on the technology side, because it's true that even large groups today cannot do without innovation in technology. And in the past 10 years, it was completely absent from conversations from an investor's point of view. And today, we have to address innovation through technology. And it has been by far the largest disruption event in the luxury industry. And it's fascinating to see how large groups go hand in hand with smaller companies, which are innovative and experts in what they do, especially in technology, where luxury is very far from the culture of technology. And therefore, I think that the collaboration between large groups and smaller companies has never been stronger. And maybe to rebound on your question, the sweet spot, it's difficult because today is a very complex world. It's more complex today than in any previous years. If you look at the market, I think the winners will be the ones who are able to understand this complexity and address at the same time the Gen Z, so the younger consumers who are absolutely reliant on technology when they purchase goods, and they are looking for experiences. Each time also they look at a luxury item. We have to address these types of consumers, and therefore being super innovative in terms of communicating. And at the same time, never forget the DNA of a brand. I think this is absolutely key. Never forget where you come from, your heritage. I think the world will develop in both ways. The democratization of luxury with the younger population, and at the same time, premiumize the high end and the image of your brand to keep the desirability super high. Those companies that are able to do that, I think, will be the winning ones. One angle of development we look at a lot, maybe more concretely, is East, so Asia, for consumers. Clearly, we have seen China being the main growth driver for the luxury industry in the past 10-15 years. There has been a bit of a bump with the COVID years, for sure. But we do remain very optimistic, actually, on China in the long term. So we would expect the companies we invest in to have a long-term strategy in Asia, not only China, but I would say overall in Asia, because if you look at demographics simply and the types of consumers who crave for Western luxury brands, there's a lot to be done in those countries. And that adds to the complexity I was talking about earlier, because you don't necessarily address an Asian consumer the way you would address an American consumer. So you have to be agile also in the way you do business.
Absolutely, and I think the word you used was experience. That's the big difference now, right? That's the thing.
I'll just bounce back because she said something that for us is really a main focus point, which is what we call generational shifts in terms of, like, we see countries like Japan, but China to a certain extent, where they have demographics that they're going to face in the next 10 years, probably one of the largest transfer of wealth in history. We're going to see this at a certain degree in Europe, but I think it's not even comparable. And we see this also in the GCC countries as well, which means if brands wants to stay relevant, I think that this time has never been that ambivalent for them in their value proposition to make sure they stay relevant. for consumers who were literally born with an iPhone in their hands, and their perception of value and interacting with IP is probably not as powerful as someone who had the atoms, which means touching a real product in the hands. And we see this also in the luxury business. We see marketing, CMOs, people who are really we can feel they're not that confident anymore for the next 10 years as maybe they would have been 10 years ago. And like, how are people going to interact with their IP digitally?
Change of channels, talking about distribution, direct to consumer, we've been talking a little bit about that. It's a current trend, and also the second-hand market or the resale market. How is that affecting the way the people you're investing in actually work? Is that something that you're looking at?
The second-hand market is definitely developing very quickly. And I think the big brands completely understand that trend, and they actually want to be part of it. And we see more and more large groups integrating second-hand platforms, or at least looking very much at the business. We know that Groupe Richemont acquired Watchfinders a few years ago, and many brands are actually looking at participating to this very quickly evolving market. That's definitely a trend we see in distribution, and that goes hand in hand with what you said earlier, actually, on the experience related also to distribution. So at the same time, companies invest more and more in large shops where you can experience the brand in a proper way. So just not see the products, but also more and more you have exhibitions of art, you have VIP rooms, you have cafes, restaurants. So it's all about the experiential element of a brand within a distribution framework. So it's both physical and digital. In my view, one doesn't go without the other. And I would expect the growth in both physical and technology in terms of distribution. Yeah.
So for us, like, secondhand was pretty detrimental. Actually, we said no to 2 deals this year for different reasons, but I think the key here was identification, because it goes, I think, just beyond, is my product the real deal? Is it the real one? But what is the quality? What is the status of it? How much it's been used, and how can I put a grade on that to enable, if you want a homogeneous kind of secondary market, the problem is that you need kind of like a peer-to-peer interaction to enforce liquidity on your marketplace. But then you need this kind of like central authority who's going to tell you, oh, wait, this is a good product. You are allowed to put on the market. And I mean, we've seen a lot of solutions that have been out there. Obviously, they are like very famous consumer brands. But I mean, I think the number speaks for themselves. This is like a double-digit growth that we're witnessing right now, which is very in line with like the consumer behavior change, which means people have kind of like ADHD and what they like in possessing. They want the next big thing. And they're ready to sell what they just purchased to acquire the next thing. So we're still looking for it. We're interesting. We think it's going to be very localized marketplaces. We don't really believe in global marketplaces because of the reason I mentioned before. But I think there's a lot of opportunities for regional marketplaces to build up in very niche sectors, for sure.
This is the Luxury Innovation Summit, right? We're talking about innovation. What cases in the past, say, year or so have you had in particular where you've seen a company innovating in particular, and that's driven you to invest with them, for each of you?
So for us, we got driven to luxury through investment into technology startups that were servicing these end customers on a more B2B aspect. So we were never inclined of like, oh, luxury is an innovative sector, maybe we should look into it. However, what we've seen the best right now in terms of really groundbreaking is definitely in CRM technologies, and user journeys, understanding better, traceabilities. These are the technologies that I think are really working well, and when we see a real innovation. Now, in terms of end customer, in technology, there's no such thing as a luxury technology, ever. I mean, it's never worked. I mean, there's been these kind of like attempts of like making these super expensive phones, but the emphasis was on the materials, on the stones, but you cannot really sell technology as a luxury product. Technology is an enabler in terms of like, it makes your end value proposition more compelling, but it's not an end value. And I think that's where there might be like some misunderstanding, like, bring technology into luxury. It means how can it enable my end value proposition as opposed to being the end value proposition.
Yes, innovation actually, I think it has been part of luxury more than people say across the years. And I mean, you look at brands that have been around since the 19th century, they would not be here today without innovating and following consumer trends. I think we need not to underestimate the innovation angle within brands. But what is true is that in the past 10 to 15 years, things have changed quite a bit with technology, again, being the one single most disruptor of the industry, and suddenly there was a catch-up to be done on that front. So technology definitely, not only on the supply chain, but also on the distribution as well, as was mentioned. Every big company is looking at metaverse today, even if it's not something which is heavily used. Everybody is investing, and I am quite convinced that it will be here in the future years as a major means of communication and reselling platforms as well through the NFTs. So that's a key thing. Another innovation which
so you're bullish on NFTs and on virtual products?
I think so.
Okay.
I think it's going to take a little bit of time because things are quite slow moving in the luxury industry, and before they actually embrace totally this technology, they're going to need to have proof that the brands will not be diluted through that.
But is that categorized? Because someone was mentioning before, well, will people buy a virtual watch, or will people? But maybe they'll buy a virtual car, or there are categories, right? In that.
But I think for the moment, at least the large groups we talk to envisage the NFTs as a combination with a product. Then the next step will be to go directly to the metaverse without having the underlying product. But I don't know.
I fully agree. In the step of we need to understand, and I think internet gives us a great example about what we should expect. We're expecting basically to be able to travel to Mars, in over a year. It takes time. I think right now, phygital is the way to go. People have this proxy of their social status that they have in the real world, and they can replicate that into the digital world. Now, the factor here right now in the situation is that people on social media has a persona of oneself, what they project of oneself. So we don't need to be really a math genius here to understand that, as you said, with AR, Apple glasses, etc., people will have to replicate that persona that they create with themselves into the digital world. And this is where it starts to be really, really interesting. Now, of course, there's a leap of faith in terms of the social consensus of digital value, which is a complicated topic. I guess it's more of a general conversation. But we can see this already. We're talking to top brands. They're all invested into it because they understand that we're not far away from this, perception of digital value being that on the same level as a real world value. The key here being, the temporality and obviously the dilution of the brand, which is the main concern.
Digital artworks is, of course, the perfect
100%.
example, right? So
100%. You see, I don't know if you've been to MoMA in New York, but they had this Ricky Anador exhibition that was in March, April. So many people were stopped watching it because it was so groundbreaking. It was so incredible to watch that they had to add security to move people. You were allowed to watch it only for 2 minutes. And it was pretty impressive to see that, okay, there's been a leap forward in hardware. It's not these dodgy screens with low quality pixel. No, I mean, we're entering a space now where technology is strikingly good. You go this through generative AI, you see this with hardware. There's really been a leap forward that makes now a compelling value proposition.
Okay. Caroline, what are the key factors that you take into account when you're evaluating premium brands for potential investment, and how important is the brand heritage in your assessments?
Yes, so because we are looking at premium brands across consumer segments, we have to select a few criteria which for us are key for a company to create value over time. We have 5 criteria that we look at. The first one is differentiation. Differentiation is key, and all the great companies we could listen before, I think it's one of the most important things is how do you differentiate versus what already exists. The second thing is experience. So it has been talked a lot during this conference. Not only it's a product, but it's about building an ecosystem around the brand, physically and also digitally. The third element we look at is integration. What we mean by that is, we tend to prefer brands that are integrated on the supply chain and on the distribution, just just because they control better the quality, and they also control better the data from the consumers they cater to. Third element is digital. So again, back to technology, it's about the digital strategy across the value chain, again, with omni-channel being the very end game on the distribution front. And finally, it's pretty much a financial criteria we look at across investments. We look at CFROI, so cash flow return on investments for every company we look at. Companies that invest in anything, we want to make sure that their investment returns cash in the future. So we try to assess the investment policies of the companies we invest in, including technology. We want to make sure that the big investment they make today, at the end of the day, will be able to produce more profitable growth tomorrow. So that's basically the map we look at when considering an investment for the fund.
Okay, Quentin, what are your key criteria? You mentioned it a little bit before, but how do you pick and choose?
So obviously we come at different stages right here. Obviously for us, number one is, okay, an idea is great, but an idea is 30% of a success usually. And when I say 30%, my father would probably say 10. But anyway, it's 30%, and then the rest would be like, okay, what is the market opportunity, the momentum, in terms of, if you're right too early, you're wrong. And even worse is that if you're the only person right in a room who thinks you're wrong, then you're wrong. And that's the horrible truth sometimes of entrepreneurship, is that...
It was the first tablet PC from Microsoft was the perfect case of that.
Exactly, yeah. Right? And so you have a lot of these, and that's the problem with technology that people don't understand, that it's not always the best technology that wins. I mean, we had this with DVD, we had this with a lot of solutions. I mean, even Apple had to use USB-C now, because they realized, wait, we were wrong, but they've tried to fight it for, 5 years now. And so that's the biggest problem we have. And then the second that we see is okay, how fast can they deliver on a product? We have a problem, I'm going to tell this as a Swiss person, is that we have a cultural problem, which is we like to die in beauty. A lot of entrepreneurs want their product to be 105% ready to try to market. Where I was working in China, when you have 30% of the product ready, you just try it. Because you want immediate customer feedback, because every single dollar you're going to use in product development, this is immediate market fit. So it's dramatically increase your capital efficiency for these investments. And that's what the culture we want to bring to entrepreneurs who try to market ASAP. We see a lot of entrepreneurs who want to raise $500,000 to do crazy marketing. I'm like, no, you don't need that. You just bootstrap, just go do affiliate marketing, total influencers. If they like your product, they'll do it. And, show some kind of growth, show that you can scale, and then it starts to be interesting for us to come in.
Okay, we have about 7 minutes left. I'd like to open up the floor to some comments and questions. We already have one over here. Ben, if there's a possibility, I'm sure there are. And again, if you have ideas rather than just questions, I'd love to hear some of your ideas when it comes to this area as well.
Hi, James Cook. I'm a consumer equity analyst, actually, so I appreciate your perspective, Carolyn. I'm just starting to look at luxury. And in 1989, Bernard Arnault bought Vuitton, and it was about 500 million euro, and his Belgian banker told him it was almost over-distributed. It was a $20 billion business last year, euro. Is there a ceiling for luxury brands if they do the right thing? And what is the right thing?
Very good question.
Thank you for your question. Yeah, it is a very good one, and indeed, I think every year people argue that Louis Vuitton is finished because it's over-distributed, as you say. I think the way for a luxury brand to keep expanding and keep creating value by growing is by expanding in categories. So what we have seen with Louis Vuitton, I mean, it's quite striking. They are going from handbags, to, as you have seen, to the apparel industry. They are now into the jewelry business. They are also going into the fragrance. And the way of playing your brands through different categories, not only it naturally expands your reach out to consumers, but it also allows you to reach out to the younger and maybe more middle-class consumer through goods which are more affordable. So you do create value a lot by doing that. And the other way to do it, to grow so quickly without diluting your brand, is to expand horizontally. What LVMH did through acquiring hotels, but also they have a big beauty business. So you are able to leverage your brand on different categories within the brand, but also potentially horizontally through a group which can make synergies for your brand. It's quite interesting. I mean, if I look at Hermès, today Hermès has a higher percentage of their sales in non-leather goods than in leather goods. And historically, I mean, of course, and everybody knows Hermès for the Kelly bag and Birkin bag, but the reality is that if you look at the growth that and they have been among the highest growth groups, the growth is actually coming from the non-leather goods, but it's still Hermès. I mean, they are able to leverage their brand throughout categories. So I think that's the answer.
Okay. More comments or questions? Comments we love as well, by the way.
Yeah. Hello. My question is for Quentin, and it's around the topic of you investing into businesses that are around CRM in the luxury space, because this is really knowing the customer, understanding who the customer is really important. Currently, as it's a global world, the CRM is important to understand globally. But a lot of these luxury brands, their CRM systems are quite fragmented. I was wondering, based on the companies you invest in, how are they tackling that?
So that's a very good question, thanks, because this is how we got into actually luxury, right? I think the CRM is incredibly interesting because let's say you're going to have conglomerates of groups. The only question is like, okay, how can I have an understanding of my user journey of my customer outside of him interacting directly in the shop? Because when you think about this, this is one of the worst data you can have, right? You have very situation-driven behaviors. It's somebody who comes in the shop, who wants to buy, buys, gives you limited information. You only know his amount, his age, name, and then he just leaves, and you just have a pathetic little email to send some trashy stuff once a month, right? So this is the worst we can have if you compare to other industries when, like, let's say automotive industry right now, that's the beauty of Tesla. Imagine the kind of quality of CRM they have. And I think this is where we saw the push with Web3, is like, how can I subtly put a wallet through my reward system and my CRM with my users? Because then I have a snapshot of what is happening. And I think LVMH here is really striking about what they're doing. I can tell this because one of our portfolios is pretty in bed with them on building this. It's like they don't really care on a micro level on the CRM, like that John or Adam does this, but on the macro level, the amount of data they can have, the interactions with that user between the brands, that is groundbreaking because it allows them to basically have this knowledge of understanding the macro data of their users, how they interact with certain IPs, what I call IPs brands, different IPs within the conglomerate, but also to a certain degree to what frequency and all the IP maybe of competitors or other stuff. And all of this is anonymized. That's the beauty of it, right? They don't know. So you're fully compliant in the sense. This is just an iteration of an address that is just being, managed. So the analogy of the CEO was like, Quentin, it's like if everybody has a party, had a balloon on their wrist. What you want to see is where the balloons go if you're looking from a balcony. And I think that's the best analogy that, that got us to invest, because we're like, wait, this is compliant, and it solved the biggest problem that retailers have, which is understanding the user journey flow.
Great. We have more questions.
Hi, Quentin. This is another question for you regarding the SaaS market for serving luxury brands. Do you think there's any room for pricing power amongst these SaaS companies when they address a market that is so consolidated? So you mentioned this company serving LVMH, but what is your room basically to set high prices when you have just a couple of customers, basically?
So, a SaaS business model is a great business model because it's always, you price in like, how much can I make you money? How much my product will help you make more money? So in that sense, the elasticity of the pricing is technically infinite in the sense of like, if you bring something that is really groundbreaking. And we see that some SaaS business models are so good that they not only take a SaaS business model, but they also take a fee above it, right, on flows. So I guess it's really, I cannot give you a general answer here because it's very, use case specific in the sense of like, how much can you change or improve the revenue or the data that the company can have at the end of the day. That's really, I guess, the $1 million question.
Great. Another question.
Hi, I'll not name the fund, but I once received feedback to say that they were used to being presented to by men and found it very difficult to understand sort of or get the same perception of my point of view as a female entrepreneur and CEO. And that is often because men tend to be a little bit more bullish on the way that they present and maybe present a concept without considering some of the detail and the thought processes in the intricacy that women will behind that. But in the world of luxury, where detail and quality and that customer relationship and experience is key, do you think that funds need to adapt those processes to welcome those thought processes, and how do you personally do that?
Is that a question for me, or yeah?
I think more for yourself, because you're really focused in luxury and startups like yourself.
So, there's a famous sentence that I said to all my friends, is, in my world, it's facts tell, stories sell. At the end of the day, and luxury business is a storytelling business. So I think it's perfectly adequate. I think if you're great in the luxury and comfortable, you will be great pitching to funds. It's how compelling your story and your value proposition. At the end of the day, the fund manager really, and I know no fund managers at all who would basically say, wait, it's a great story, but it's a woman, so she's too detail oriented, I'm not gonna go for it. Like, data is there. Analysts don't care. Analysts don't even know what's happening. Usually they don't listen to pitches. They just send a memo to committee with data. So that's where it comes from. But the story and how you're going to package this is super important. In my experience, and you're right, men's more straight to the point. First slide, what do we do? Done. Like, we don't really care of who you are until the last slide. Don't tell us this. But for sure, in terms of like how you want to pitch, the story is compelling. Project the problem needs to be a projection of the fund. He needs to understand, you're in a shop, you have this problem, you never thought about that. And then you're putting him on the passenger seat so he can understand better what you're trying to explain. And that's, I guess, the main problem that I've seen, yeah. If that answers your question.
I think it does. Do we have a final question? Yes.
Yes, thank you very much. It's a more comment than question, but
comment,
it could be commented anyway. Well, we are in Luxury Innovation Summit. We are not in Luxury Invention Summit. But if we were in Luxury Invention Summit, our debate, it will be more on technologies. But there is a difference between innovation and invention. Not really big difference, because invention, it is mainly technology, and it could be patented. Innovation, it could be also just an art, and not necessarily patented. But nowadays, we are living in 21st centuries, and there is various generation of technologies, new technologies, high tech, and highest tech, new technologies. But the phone itself, there is various generation, 5th generation. But anyway, just to say that mainly the usefulness for the luxury sector, it is very good business thanks to IT, information technologies, and nowadays there is ICTs, information communication technologies. This is a very important tool in luxury industry. Thank you.
Okay, thank you. I think that's all we've had time for. I'd like to thank very much Caroline and Quentin for joining us here. It's been an extraordinary session, and thanks again very much for joining us.